Welcome back, everyone. My name is Adam. I have Rusmin.
Hello.
Victor.
Hi, everyone.
Thank you once more for joining us. Today, we're going to talk about our own home market, Singapore.
Yep.
And whether there's an opportunity to invest in Singapore. Because a lot of times people think that, hey, Singapore, maybe not so exciting.
Yep.
So we want to find out if that's actually true, whether there's actually some performance going on here. Maybe the dividends are good, and actually the returns, if you look at it since COVID, have actually been pretty decent. So the Singapore market, or the STI particularly, has quietly done pretty well over the since COVID, basically.
Yep.
And you get dividends and tax-free stuff and stuff like that as well. So we want to find out whether it's still good to invest in Singapore for certain things, and what we think about that. All right. So maybe just a very quick intro about Singapore, or the STI, its components, and all that stuff.
Yeah, okay. Look at the Straits Times Index. Basically, it's the index that tracks 30 largest companies in Singapore, right? So you have your top 10 constituents like your DBS, OCBC, UOB. These three are the biggest bank in Singapore, and they already account like 50% of the constituents of your entire index, the holding itself, right? And then, of course, you have Singtel, CICT, Ascenders, Jardine Matheson, Singapore Airlines, SGX, Keppel, and of course, the list goes down all the way to the top 30, right? And this index basically captures the top 30. And the whole idea of having an index is always to gauge the performance of Singapore market. And how do you do that? Basically, you refer to Singapore Straits Times Index, the Straits Times Index. So that's how people actually created the index. For
the representation of our economy in a sense.
Yes.
Okay.
Yeah. So if you look at the, I think, industry breakdown, so bank alone already constitute half of the location, and then followed by real estate, which about 17.2%. And I think within this real estate itself, of course, you have REITs, which I think account about 11 over percent, right? And then the rest, of course, you have your capital land, investment, stuff like that. Okay, so and the rest are quite diversified across different subsectors, right? So so this is what makes up the STI.
Okay.
Yeah, which represent the Singapore market. Yeah.
All right. So over the last 1 year, I'm going to give 12 months. The STI has returned about 13%.
Yeah.
Yeah. So this is excluding dividends, I believe, or is it? I think it's excluding dividends.
Dividend.
It's just based on the price. So if you add dividends to that, it's actually even better. So 13%, I'll just use that. So it's actually done pretty well. I think there was 1 year where I think Singapore was one of the best performing markets as well.
Yep.
I think it was in 2022.
After many years.
But I think it was 2022 when the US wasn't doing so well.
Yeah, every index is down.
Every index, but the Singapore market was actually pretty resilient. So what's the valuation of the STI right now? Is it still something that you could look at?
Yeah, I think if you look at the STI, Straits Times Index, there are many ways you can value the index, right? So either you based on price to earnings or price to book. But in the case where you have a lot of stocks, this index have a heavy concentration in banks and also real estate, I think price to book would be a better indication to represent whether the whole market is actually expensive or cheap, right? So if you look at the chart over here, price to book right now stands at about 1.25 to 6 there about. If you compare it based on the 10-year average, which hovers around I think 1.15, 1.14, so it's kind of telling you that the market is slightly expensive, right? I bet that's because of the runs up that we have seen over the last few months, okay, because of the rate cut that actually benefited REITs, and also bank I think have hold up pretty well, right? But if you based on 15 years average, which averaging at about 1.28, right? I think right now is the whole Straits Times Index is actually considerably fairly valued. It's neither too expensive or not too cheap. Okay. So I think over time we may see the average to slowly continue to move up, because I think if you look at the constitution in the STI alone, there are a lot of companies that are actually going through initiative, right? So Victor, maybe you want to share some of those initiatives that they've done.
Yeah. So I have a table over here showing the top 15 holdings of the STI. So if you look at the top 3, which is the banks, right? I mean, the business is, I would say, is bank business are relatively easier to grow because it's money grow money, right? Yeah. So the thing boils down to the bottom, everything below the bank, right? So if you look below the bank, right, I have this thing called initiative on the right side of the column. So those with yes, right, that means those companies are doing some initiative, like divesting non-core assets, divesting some assets, return capital, doing share buyback, or spinning out their assets, right? So let's start off with Singtel. So Singtel, in the recent years after the COVID, a lot of these companies start to do all this initiative after the COVID pandemic. So Singtel undergo a strategic reset, I think around 2 or 3 years ago. They unlock a lot of their hard assets, and they also sell a lot on the non-core assets. And they start to take a part of the money, they return additional capital on top of the dividend that they're paying out, right, to shareholder. And they also focus on growing. Now they are much more focusing on their telco, NCS, and also the data center part of the business. Then if you look at Jardine Matheson, right, Jardine Matheson has also stepped up their share buyback program. Right, before COVID pandemic, they didn't really share buyback, but the share count slowly increasing. But after the COVID pandemic 2020, right, from there until now, right, their share count have reduced 21%. So they have been buying back share because they think that the companies is cheap. Then you have capital and capital land investment, where they move from more asset heavy business to asset light business. Right. So they clear off delist all their asset heavy business, or sell away their asset heavy business assets, and they focus on asset light business. And Wilmar International also spin off their consumer cooking oil business into a separate exchange also. And Hong Kong Land also, which is owned by Jardine Matheson, also have been buying back shares, and they already reduced about 5.5% of their share counts. So all these initiatives that all these companies add up, it's about 19% of the whole STI ETF. So these are initiatives that will, I would say that they are they're slowly moving towards asset light also, and also which means that Bruce Min said that the book value will slightly go up because they become more asset light instead of hard asset type of business.
So that will move the averages up. That's what you're saying.
Yes.
Okay. So anyway, we're going to come back to these initiatives that you mentioned, because these are basically actions by the management that are shareholder friendly. They aim to boost returns in a sense. So we'll come back to that about how this will help the Singapore stock market. But I think one question that a lot of people have about is investing in the STL in Singapore is that it's a very, is it over concentrated in the banks or in the REITs? If I invest in the STI, it's 50% in the banks, or it's a lot of real estate companies, a lot of REITs. Is it like a very slow growing dividend kind of ETF? I think the yield is about 4%, which is pretty decent, but that's the criticism that it faces. Like, is it too slow? Is it just like a dividend ETF nowadays?
I think if you talk to investors in Singapore, they will say that Singapore is a boring market, right? So why invest in Singapore when you have that US market that performed very well right, over the last 10 years or 20 years, right? So again, you have to come back to the why some people actually might be interested to look at the STI or Singapore market, right? So there are many reasons why investors will want to look at Singapore market. I think first, most obvious reason is, of course, we have the best airport in the world.
I think that's true.
But of course you can't invest in that. Too bad that is not a listed company. They should list it actually, right?
One day.
So but I think the big reason why Singapore is attractive is because it's a politically stable country, right? And it has the best. It's considered the financial hub in Asia, right? One of the best. Of course, it competes closely with the Hong Kong market, right? But when it comes to Southeast Asia, Singapore stands out. Actually, if you look at the top 10 constituents, the top 3 banks alone, I think at least one third of the business are already outside of Singapore. Right? So that will give you exposure to the Southeast Asia market. Right, and of course Singtel also, I think they have a big exposure in India, also Indonesia, and CICT is largely mostly in Singapore. Jardine Matheson also very big in Indonesia, and also they have a lot of properties in Singapore also, as well as in Hong Kong, right? And so by investing in Singapore, essentially you are trying to capture the growth in the Southeast Asia market, right? So that is one main reason why I think people are looking to Singapore market, right? And of course, second reason is we have the best chicken rice.
Some people may disagree with you. Malaysians?
Our Malaysian friend, yes. But generally, I think as a global financial hub, one of the global financial hub, I think in terms of ranking, Singapore come out of the top 3. Used to be top 3, but now it's top 4 because Hong Kong has come back up again. And that actually makes the whole country, if you look at geographically, I think Singapore is constrained by the lands, right? There's a scarcity of land. So when you invest in property with limited land or limited supply, generally the valuation for the property or asset will appreciate over time, right? So one of the best way to have exposure in Singapore market through their commercial real estate is actually by investing in REITs, right? Which is now we are actually well known for that, right? And so property alone, I think Singapore will do well, over the next term. 10 years, 20 years, largely driven by the growing population. I think Department of Statistics of Singapore just came out with demographic. I think we already hit like 6 million population for such a small
Some people are not too
island.
happy with that. So it's packed all the time.
But that I think
but that's
population
economic growth.
growth is going to drive the economic growth.
Yep.
Right, and with low unemployment rate, I think Singapore, the whole economy generally will continue to do very well. In fact, I think the minister just said that if we can grow at 2-3%, we'll do pretty well.
Okay.
For the whole country, right? So, so those are some of the fundamental reasons why I think some people like Singapore. Okay, and the most obvious reason I think is really the currency.
Okay.
The strength of the currency, right? So Sing dollar, if you look at the performance over the last 20 over years since 2000, okay, you plot it out against other currencies like US dollars, rupiah, rupee, ringgit, Australian dollars, and then of course your Chinese renminbi and all that. I think Sing dollar actually have beat almost most of them.
So this is like, foreigners investing in Singapore in Sing dollars.
Yeah.
They get an extra return,
a
boost from our growing currency as well.
That currency stability actually offer a big advantage, especially for local who stay in the local market. You don't have to take on currency risk like yen or US dollar, which has recently weakened, right, against Sing dollar. So, by staying in Singapore, they don't have to take on currency risk. And I know that a lot of retirees, or even like my father-in-law, he doesn't like to go outside of Singapore because he loves Sing dollar, the strength of it that it can offer, right? And largely because Singapore is politically very stable, it attracted a lot of family office, and then you have Dyson families, you have like Haidilao families. I mean, these are guys who, when they bring their wealth to Singapore, that will boost the financial businesses in Singapore, and banks will benefit. Right?
I think that's the way that the government does it. They try to attract amenities, create jobs and everything. I think Dyson recently had some news about layoffs, which is not so good. We'd call that out. But basically what you're saying is that, when you invest in Singapore, it's actually not just Singapore, because a lot of companies that are Singaporean have exposure to other markets. And so there's growth elsewhere, not just in Singapore. So don't just look at, Singapore companies or STI is just a Singapore market itself. It's bigger than that. You're also saying the currency is strong, so it's growing as well. And if you are looking at property specifically, it's going to do well if it's just in Singapore itself because of the scarcity. So these are the reasons why someone would basically consider STI or Singapore.
So being a financial hub in Asia, I think banks will do well, right? And then of course your property is also will do well because a large part of the REITs actually have their properties in Singapore, commercial property like retail, healthcare and stuff like that, right? So, and that STI actually capture about a lot of it. Although I still think that they should increase the proportion in the REITs allocation. Right, because the REIT, I think the contribution now only is about 11%, right? And they should continue to push it up higher, because it's one of the main reason why Singapore is the REITs market, right? And it has done pretty well in Asia, right? So, so I think generally that index actually captured most of it, right? But obviously you can't just invest in index. Index is just a hypothetical portfolio that they created to measure the performance, right? The only way you can invest in index is through ETF, right? So, and we have like two main ETFs in Singapore that capture STI. One is Singapore Straits Times Index ETF. The code is ES3, right? And then the other one is Nikko AM Singapore STI ETF. Both of these ETF capture the entire STI. They try to mimic the return of it, and so far they are quite close to it. If you look at the past 1 year, 3 years, 5 years, even 10 years, the performance has been great for Spider ETF, and even since inception also has been compounding at about 6.6%. I mean, to some people this is not great, right? But to a lot of retirees or those people who are looking for dividends, this kind of return I think is pretty solid. Especially you don't have that such a volatile market like what we've seen in the US can crash by 50-60%. So the return, if you are okay with like 5 to high single digit kind of return, I think STI should be able to deliver that, right? Mostly at current market valuation, maybe mid single digit performance over long term, I think it's still doable for STI.
All right. So what is the? I think the yield for the STI now is about 4%.
4%.
Yeah, about thereabouts.
So you get
4+%. So you got to factor that into your returns. What is the long term return from the STI with dividends reinvested?
Yeah. So I have the I compared the STI versus the S&P 500 gross return. So gross return means that the dividend is reinvested, excluding all the fee and the charges. So that means, for instance, if you have bought into the US market, you have a 30% tax on the dividend, right? It's also not included.
Okay.
It's assuming that it's reinvested back again. Okay, so you can see the STI before around 2015, in the mid 2015, all the way to now, right? They are underperforming the US. Right? So now a lot of people is going to the US market and they say that the STI is underperforming and people are more inclined to invest in the US market. But if you look into the history, right, before 2004, right, the STI also underperformed the US market. Then after 2004, they outperformed the US market from 2004 all the way until 2015.
Okay.
Before this cycle switched and now they are back to the thing. So there's days where STI actually do outperform.
Not just days, right? Years.
Years that the STI actually outperformed the US market, right?
Okay.
So right now it seems like they're underperforming, but with all the initiative that those company in the component doing, right, we can expect the STIs to be higher probability that they will be doing much better moving forward in the next few years.
Okay.
Yeah.
All right. So there's actually a period where sometimes the Singapore market does better than the US. I think it's pretty unfair to compare any market to the US because honestly, the US is the best.
Correct.
I mean, it's the best, the biggest
market.
economy, the best innovative companies and everything. I think it's a bit unfair to say, oh, Singapore, you can't really compare. I think no country can compare to the US.
And if you want to compare US, you have to compare inclusive of dividend reinvested. Okay, because if you use just purely the price chart, the price return chart with the US price return chart, Singapore looks like the gap is very big. Right. But if the moment you add in the dividend, the gap actually reduces already. Right. So because Asian markets is tax free in terms of the dividend. So when the dividend we take up front and we reinvest, right, that's will give up. It's like you collect your rental,
you get all of it.
And buy another property. It's the same thing. And you just go up again.
Okay.
Right?
I mean, not all Asian countries are tax free. Singapore, Hong Kong, but that's one of the advantages that we have. So I think, like I said, I think it's a bit unfair to compare it to the US. The US is tremendous growth, but I think the Singapore market has different qualities that are great for a certain type of investors as well. If you're looking a bit more resiliency, a bit more dividends, I think that's great. But I think the same question can be asked, how can we actually boost the Singapore market? Because at the end of the day, yes, it's great, the dividends are solid, but I think we also want to improve it, like see if there's a way to like spruce up or like re-energize or energize the whole market. What are your opinions on how this can be done? I think you're talking about initiatives just now. There's a step in the right direction.
I think if you look at those companies that do the initiative, right, their share price performance tend to do much better after they did the initiative, especially for Singtel.
Okay.
And also, I think Capital Land Investment also. Right. So initiative is very important. In investor term, we call it capital allocation. How are they allocating the capitals and giving back? Okay. I think what we are facing in especially Singapore is that a lot of the listed company, not a lot, quite some of the listed company, right, when they list, right, they still own like 70% plus in terms of the shareholding structure.
Controlling stake
inside the company. So when they have controlling stake, right, they sort of, when I go to the AGM, right, it gives me the feeling that it feels that it's their own business.
Family business?
It's their own business. I mean, right? The shareholder, they don't think of shareholder. Sometimes shareholder ask question, they can scold the shareholder.
Okay, you've seen that.
I've seen that before in the AGM, right? So I think that's the problem, because the shareholding structure is so high, and these people, they don't think about capital allocation. Okay, in the US it's different because the shareholding structure is so low. If you don't do anything, or you don't do any capital allocation, activists can come in. But in Singapore, because of the shareholding structure is so high, even when the activists come in, it cannot move it because the controlling shareholder owns too much. Okay, I think the way it is to really switch this situation is, right, that's why they talk a lot of corporate governance and all this, is that if the exchange says that, okay, you want to list in Singapore, but your holding cannot be more than 70%. Must be like 60% and below.
So the public float has to be a lot higher.
It's a lot higher.
Okay.
Then there's a chance that, okay, you go in, you don't do your job, it's okay. The activists will come in. And the activists got power to push you to do capital allocation. But right now, the activists come in, they cannot push because of all this 70% shareholding structure of this some of the companies.
Okay, so I guess you're saying that some, not all, some companies are not so shareholder friendly. They kind of like treat the company as their own business, and they just run it that way.
Yeah.
Yeah, but I think the more, I guess the bigger companies are more maybe the government-linked ones, because it's more professionally managed in that sense. They do take some initiatives, shareholder-friendly practices and stuff like that, and that helps with the share price.
Correct.
And the interest.
Yeah,
from
the important
investors.
thing is really capital allocation.
Okay.
How are they going to allocate capital? Like now Singtel is doing the capital allocation, and it really shows the result. Right. I mean, nobody forced them. I mean, the new management came in, they decided to switch everything.
Okay.
Completely different from the previous management.
Okay.
Right.
Yeah.
Of course, the other issues that I think as Singapore or SGX is facing is that we have lack of technology companies. Right?
Okay.
So unlike in the US where you have like your Magnificent Seven, I think the technology's whole sector actually represent about 1/3 of the entire S&P 500. In Singapore, technology only represent 1%.
Oh.
So a lot of stocks, if you look at the STI constituents, we call it the all economy stock, right? Or banks, or financial companies, and then your real estate, right? So all these are considered all economy. In the last 10 years, 15 years, especially after COVID, a lot of growth actually come from the tech sector, all right? And Singapore didn't really benefit from that because we don't really have tech companies here. We don't really have a strong startup, scenes like what you have there in Silicon Valley, right? So and then we have some unicorns like your Grab, C, Holdings, right? But all these companies, they in the end, when they went listed, right, they went to the US, right? And same thing with Property Guru, which got listed I think in 2022, right? But recently going through privatization, right? So and of course Razer also at one stage, I remember that I won't consider them as a tech company, but they have a very strong cult following. When they went IPO, they decided to choose Hong Kong. Right, so that is the problem here. There's no enough representation of technology company in Singapore. So one way, of course, is to bring or convince some of these guys, hey, look, you guys, your HQ is in Singapore. Why not you dually list here in Singapore, like what Jardine did?
Okay.
Right. Not only they are listed in Hong Kong, in London, but they also listed here in Singapore. I think that is one way to also boost that constituents, that representation of technology. Although I think so far Grab and C, the share price have initially they've done very well during the COVID, right? But recently last few years have crashed since 2022. But it's good that to have more constituents in that index itself.
Okay, so what you're saying is that yes, they can list overseas, and there are reasons why they do that, because they get a better multiple overseas.
Also.
But if you do that, consider doing a dual list in Singapore. I mean, I don't know what the steps are or what the considerations are to be able to convince these companies to come here. But if they can do it, it's a good thing.
Yeah, I think everything still boils down to capital allocation.
Okay.
And whether the business got growth or not, right? Because at the end of the day, if there's no capital allocation, the business got no growth, these companies are going to trade at very low multiples. And that's what happened to some of the companies that was privatized in Singapore.
Okay.
Right? So because they didn't do enough capital allocation, they did not show. I mean, we have seen example of a company, right, where they announced very good profits, right, during bad times. They announced very good profits. Instead of giving more money back to shareholder in terms of the profits, right, as dividends, they say that they're going to cut their dividends.
Okay.
Right, because now it's a tough time. We're going to cut our dividends, but we are doing very good, right? And we're going to take this money and we do share buyback.
Okay.
Right. But doing share buyback and the owner itself got very high percentage of shareholding is not beneficial to the shareholder, the minority shareholder. It's beneficial to the owner itself, right? Because they already own significant stake in the company.
Okay.
Right? They should return capital back to the shareholder. And because of this thing that the management did, right, this company did, the shareholder just punished the share price. Because this is what we call bad capital allocation.
So when you have so that's why when you have retail companies, they do share buyback, and then after that, when the crisis happens, they say we're going to take the company private.
Oh, that's another thing altogether.
So I mean, we have invested in many companies in the past, Talk, or ARA, and a lot of these companies, they are good businesses out there, represent Singapore, right? And because Singapore market don't have that liquidity, it doesn't give them a high valuation. A lot of times, they decided to take it private, and at a not such a great valuation at the end of the day. So that also makes the reason why I think we decided to invest in like US, Hong Kong, also because of that, right? And that those market like US, they give better liquidity, better valuations. Likewise for some of the Hong Kong companies, although for the last few years have been quite tough. Okay, before the stimulus. Yeah, so I think this is one of the main issue with Singapore market, where you have a lot of some of the founders or family-owned business, when they list a company, they don't really treat shareholders as their partner. They treat them as like ATM machine.
That's your view.
I can make money from you, right?
Okay.
I mean, those are bigger MNC companies, or like, run by executive professional run. Usually you don't have that kind of issue. Like even like family business owned like Jardine, I don't see there's an issue with it, because they're run by professional and they have to answer to the shareholder.
Okay.
Right. So, but is the problem usually more obvious when you are dealing with some of those smaller businesses, or especially family-owned businesses in Singapore.
Yeah.
Okay.
So I think shareholding structure is the one that you need to change. The moment you want to list in Singapore, the exchange got a rule that you have to have like maybe 40% of them into the free float. Activists can come in. Definitely they will do something, right?
Okay.
Yeah. If it's too high, 70% it's very, very hard. Yeah.
Okay.
Of course, the other problem that I think Singapore can't fix is that unlike Hong Kong, which has a backing of China, Singapore doesn't have any backing. Even though we are very strong in Southeast Asia, it's just that there's no backer backing it. In the US, the market is the whole world. Right? In Hong Kong, I think they can just target China. Right? It's a big, huge market. Singapore, you don't have backing, right? And of course, you have the Southeast Asia access. But at the end of the day, like companies like your Gojek, they still go to their own stock exchange in Indonesia to list. They don't have to come here.
Okay.
So that is the structure. I think it's a inherent issue that I think it can't be solved.
Okay.
Right? You look at the number of listed company on Singapore Stock Exchange, I think more than 600 over companies listed on the main board. You compare to Hong Kong, 2,000 over companies, and this exclude the Hong Kong Stock Connect. Those China's companies they can buy, 1,000 over companies. So in total, you got 300,000 over companies, and US alone has close to 6,000 companies over there. So that you have a lot of selection, and that's where the liquidity will just go to those markets compared to in Singapore.
Yeah. There's also less entrepreneur in Singapore.
Okay. I mean,
That's
these are
also
all the
an issue.
problems. We know them. But your solutions or your suggestions, I guess, in your opinion, will be capital allocation.
Capital structure,
has
capital
to
allocation and
be
capital structure.
okay. So it has to be more shareholder friendly.
Corporate
Yes,
governance.
correct.
Yeah, corporate governance.
Yes.
Okay. So that they can't just treat it like just their own business and do whatever they want.
You look at those companies that runs very good capital allocation and corporate governance in Singapore. They are all doing very well
Do better,
in terms of their
yeah.
share price and in terms of their multiples. They tend to get better because, I mean, to be honest, minority shareholders are not stupid, right? Whether you treat them well or not treat them well, people know, right? If you don't treat your minority shareholder well, eventually they just give up. They just go to other companies that treat them well, and that will get higher valuation than the one that is not. That's all.
And convince some of these tech companies, Singapore based, right, to dually list here. I don't know how practical this is, but it's one way you can actually boost the technology component. And of course, the last one is going to be grow the ETF market.
Okay.
Yeah.
Right. So the proportion allocation is one thing that I already mentioned. I think the REITs allocation should be pushed up even more, because REITs actually is a good selling point, especially if they list Changi Airport, the assets. But it's just that a lot of good assets are not being listed. Right. MBS is owned by the bigger sense, right? So it's not here. So all this, I think the good points have to be bring up, and then we make it more obvious, right? And of course, the ETF market. Unfortunately, we don't have the tax treaty with the US. Otherwise, you could have built something like what Ireland has built, right, with their Irish-based domicile ETF. And I went to take a look at the AUM for the ETF. It's about 1.4 euro trillion, right? The size is huge, right? And if you compare to Singapore stock, all the listed company, I think the market cap the last time that I remember was around close to $1 trillion Sing dollar. Right? So if you can bring ETF into here, all right, and grow the ETF market, and that will brings a lot of liquidity. All right. So when you have a lot of ETF that invest in Singapore, so that will push up the valuation of the companies here.
Okay.
Yeah.
But despite all of these challenges, I think Singapore is still a pretty good market.
Pretty good.
Pretty good market to invest in.
Especially for dividends.
I think, I mean, I don't want you to be confused. Like, these are the things that we are just like pointing out.
I mean, we are still investing in Singapore. We invest in those dividend companies, right? Just hope that, all the other companies, they can look at Singtel. I mean, they lead by example right now. So we will see how Singtel will move from now after all this initiative, and hope like they can see, okay, it's proven of good that capital allocation do work. You will get back and hope that they learn from it.
Yeah. So I hope the MAS review, right, to boost the Singapore market they're gonna come out the report, I think, within 12 months. So hopefully they can come up with a solution that can push up the valuation.
Okay, I mean, not just the valuation, but I mean, this is like, I guess, create a more vibrant,
more
vibrant market here. But in the end, it's still, I mean, right now, it's still a pretty good market to invest in. For certain risk profiles, I think the Singapore market works really well for them. Again, I think it's an unfair comparison to the US because no one compares to the US right now at this point. So you have to take each market with its own qualities and whether that fits your investment goals and whatever your risk profile is. And I've been reading on some forums and threads as well that they do invest in Singapore because they want that dividend, they want that resiliency, and the currency is good as well. And there's all these things it checks their boxes for a lot of things as well. So it's really up to you. So we just wanted to share with you, what we think about Singapore market, because a lot of times, sometimes in the comments that you can't invest in Singapore and all that. I think it's not true. There are many reasons to invest here as well, and we just want to share some of that with you today.
I think you don't have to 100% Singapore, right? You can always 20-30%, 40%. If you are older retirees, I think Singapore can be a bigger proportion, especially you're investing for income. Right? For younger people, obviously they might allocate more in the US or even Hong Kong. Right? So it's not like you have to be all in. Right? You need to.
It's not either or.
Just like Temasek and GIC, they do have for Temasek they do have Singapore, and then overseas. They go where the opportunities are. So if Singapore can bring a lot of opportunities here, I think the money will flow in.
Yeah, it makes a lot of sense. Okay, so I think that's what we want to share about the Singapore market, because I think recently it's done pretty well in the past 12 months. And actually since COVID, it's actually done pretty well as well. So we just wanted to share that with you. All right, so I think that's pretty much what we want to share today. All right, so my name is Adam, Rusmin, Victor.
Thank you.
Thanks for joining us today. Any questions about this, feel free to put it in the comment section. We'd love to have a chat with you. If you like this roundtable, please hit the like button and of course subscribe. Many more roundtables coming up, and we'll see you again.